You ever get some news that's supposed to be good, but it just feels kind of off? Well, that is exactly what happened with Starbucks' latest earnings report. On the surface, things looked great, but the market, it reacted with a pretty bitter taste. All right, let's dive into this and see what's really brewing behind the numbers.
So here's the puzzle. Starbucks announces its first global sales growth in 7 quarters. We're talking almost 2 years. You'd expect a celebration, right? A party? Instead, the stock immediately tumbled more than 2.5% in after-hours trading. So what gives? And this is the central question for us today. Investors on Wall Street were clearly looking past the good news on the surface. They were focused on something much deeper, something kind of worrying that was hidden away in the financial statements. Let's uncover what they saw.
Now this was the big, flashy headline that everyone saw, a 1% increase in global comparable store sales. And that's a key metric in retail, you know? It measures sales at stores that have been open for at least a year, so it really tells you about the core health of the business. It was a signal that maybe, just maybe, the coffee giant was turning a corner. This is the story the company's leadership wanted to tell.
Okay, so let's start with the optimistic take, the bull case, straight from Starbucks headquarters. They believe they have a plan, and they're saying it's starting to work.
The CEO, Laxman Narasimhan, came out swinging with a ton of confidence. He's framing this whole thing not as just one good quarter, but as real proof that their massive, multi-year back-to-Starbucks turnaround plan is finally gaining some serious traction.
And this slide right here, this shows you their argument in their own words. Management is pointing right to that plus 1% global comparable sales growth. They're also highlighting a 3% rise in international sales, and that includes a really welcome 2% recovery in the super important China market. So yeah, from this high-level view, you can see definite signs of life.
So this strategy is all about getting back to basics. They're investing a lot of money in what they call green apron service, which means more staff, more hours, all to improve the customer experience. And you know what? They saw results almost immediately. U.S. sales actually turned positive in September. You combine that with the international growth, and you can totally see why they're feeling optimistic.
But that's only half the story. Now let's peel back another layer to see the much more complicated, and for some, a much scarier picture. This is the bear case. This is the reason the stock price actually fell.
Boom! There it is, a 34% drop in adjusted earnings per share. This number just cuts through all the noise. EPS, which is basically the company's profit divided by its shares, is a core measure of profitability. A drop this big? It signals that the company's financial health is getting worse, and that is a massive red flag for investors.
So here's the entire conflict in one simple comparison. You've got sales, the money coming in the door, up 5%. That's good. But then you have profit, the money they actually get to keep, which cratered. They're making more sales, but they're significantly less profitable. And that is a dangerous combination.
This chart shows you the problem in another way. Operating margin tells you how much profit Starbucks makes on each dollar of sales. Last year, it was over 14 cents on the dollar. This year, it's down to just over 9 cents. That is a 500 basis point collapse, which, in the financial world, is a huge drop.
And if you dig into that top-line sales number, you find another crack. That overall growth of 1%, it was entirely driven by international markets. North America, their biggest, most important segment, was completely flat. 0% growth. So the crucial point here is the core business at home is stagnant. So why is this happening? I mean, how can a company's profits fall so dramatically while sales are inching up? Well, it turns out the cause of the problem is also what management says is the solution, their own turnaround plan. A comeback does not come cheap. This is a classic playbook for a massive retail brand trying to reignite growth. You have to spend money to make money. And Starbucks is spending a fortune on 2 main things. First, that green apron service we talked about, that's a massive investment in labor. And second, they're aggressively remaking their physical footprint. Just look at that number. In the last quarter alone, Starbucks shut down 627 stores that they decided just weren't going to be profitable or couldn't provide the right customer experience. Now, while that might be good for the long term, closing a store costs a lot of money in the short term. And the company is being totally upfront about this. The CFO, Rachel Ruggery, explicitly calls it a multi-year turnaround. They know these investments are hurting profits right now. They're making a calculated bet that spending big today is going to lead to more durable, sustainable growth tomorrow. So this brings us to the final showdown,
the bull versus the bear. Two completely different ways of looking at the exact same set of facts. And it's your call to decide which one you believe.
The optimist, the bull, says, hey, relax. This is painful, but it's necessary medicine for a mature brand. The plan is working. Just look at the improving transaction trends. Give it time. But the pessimist, the bear, fires back, are you kidding? This is a disaster. The cost of this turnaround is destroying shareholder value, and there's no guarantee it'll even work. The core U.S. market isn't growing, and the brand is sacrificing its high-margin magic for just a tiny bit of sales growth.
And that's really what it all boils down to. Is this short-term pain for long-term gain? A smart, strategic investment in the future? Or is it a desperate, expensive attempt to fix a brand that's lost its way and its ability to command premium prices for premium profits? The next few quarters will really tell the tale.